2024 is a watershed year for elections, 77 elections around the globe, and 60 still to go. Now, the most consequential election is the U.S. election, but we've had some surprises, including the UK election coming up sooner than expected. How should market participants think about the ramifications for trade and investment and the macro outlook? And will industrial policy continue to gain traction and shape foreign policy? Welcome to Research Recap on JP Morgan's Making Sense podcast channel. I'm Joyce Chang, Chair of Global Research at JP Morgan. Today, I'm joined by my colleague, Bruce Kasman, Chief Economist and Head of Global Economics Research at JP Morgan. And we're here to discuss the economic and macro implications of the upcoming elections around the globe. Bruce, thanks so much for joining us to discuss these issues.
Thank you, Joyce. Good to see you.
So, Bruce, I have to start off with the U.S. presidential elections. We are all talking about Trump 2.0 versus Biden 2.0. Now, Trump has advocated America first. Biden has talked more about global alliances. How do you see the policy differences, and how do you see the implications for growth, inflation, and fiscal debt outcomes next year?
So let's first just make sure we get across the point here that we're not only electing a new president, but we're also electing a new Congress. And how that turns out matters a lot for what the policy decisions are going to be made under either of the two new presidents. We're basically working with a assumption that there's more likely than not to be a divided Congress, and therefore there'll be divided government regardless of who wins. And I think that makes a fairly important difference in terms of the policy side. The most important thing to recognize on U.S. policy is that the 2017 tax cuts are due to expire, a good portion of them, as we go through 2025. They expire at the end of the year. And I think if you do have a divided government, it's very difficult to see an environment in which you extend all of those. And it's very difficult in our mind to see an environment in which U.S. fiscal policy doesn't start to turn more restrictive. So that would be point number one. Under either a Trump 2.0 or a Biden 2.0, we do see U.S. fiscal policy as turning somewhat more restrictive. I think with regard to the other types of policies that matter a lot for economic performance, there really is a stark difference. From our point of view, the Biden administration has obviously engaged in important issues around our relationships with China, but has generally been supportive of a U.S. economy engaging with the rest of the world in a number of different areas. And we think the U.S. economy, in its performance over the last 4 years, has benefited significantly from our immigration flows, from our trade flows in energy, our trade flows in agriculture, our role as a tech hub, and obviously that's been supported by industrial policy as well. And I think one of the interesting things about the election is with Biden, you would get much more likely a continuity of the policies that you had in his first term. Under Trump, you would have something of a reversal. I think Trump's worldview is that the U.S. is better off going it alone. I think that hits at some of the very important positives that have supported U.S. performance. And therefore, without fiscal support, which Trump was able to deliver in his first term, and closing the U.S. economy to the rest of the world, we do think there's a significant risk under Trump 2.0 that the macroeconomic outcomes are going to be a lot less favorable for the growth side. On the inflation side, I think it is a more complicated situation that the idea of putting on tariffs and closing our relations with the rest of the world in some aspects would tend to increase prices, but the demand-destroying impact of that, both directly as well as in terms of hitting business confidence, is probably a significant offset. So I would look at a Trump 2.0 as something like a inflation impact that comes when you increase a VAT tax, which is prices go up relatively quickly, partly on the back of trade restrictions, but they don't continue and add to inflation on an ongoing basis. In fact, over time, it might in fact be more disinflationary than inflationary.
Thanks so much for that. I want to talk more about just the international implications when we think about national security and also the industrial policy that has come about. I mean, the IMF came out with a report saying that we've had 2,500 industrial policy measures, 2/3 that are trade distorting, 3 times what we saw in 2019 announced over the last year. So how are you looking at the international dimensions?
Yeah, so I think it's still early in the game to understand what the implications of, as you noted, was a very significant shift in U.S. policy towards something of an industrial policy on climate, on tech, on national security related issues. I think what we can see right now is that these policy initiatives have started to spark investments. They've had an impact on capital flows. They're still happening in a relatively narrow set of sectors in the U.S. economy. So I think from a macroeconomic point of view, it's hard at this point to say they've had a major impact on U.S. performance, which has been, of course, quite good. But it does have the potential, particularly as it integrates with some of the things we discussed earlier, our openness to the rest of the world, our tech sector, which has been one of the leading edges of the U.S. economy, our energy sector as well. It does have the potential to create positive synergies as we go forward. And overall, I think about this as a significant positive for U.S. And it also is starting to spark changes that I think are happening around the world. And we should understand that this is all happening against a set of decisions that companies are making that are shifting the allocation of capital around the world in the aftermath of the pandemic and in the aftermath of the U.S.-China trade war, which obviously started under the first Trump administration. So there's a lot at stake here. There's a lot moving. I think the U.S. is benefiting from this. It's still unclear how much that'll be. And of course, one of the things we said a moment ago is that under Trump 2.0, some of these policy initiatives are clearly going to be scaled back.
Well, the UK elections are coming up earlier than expected in the next couple of weeks. What do you see as the implications?
With the UK election, I think it's kind of interesting to note that in some sense, what Labour is mostly campaigning on is that they're not the Conservatives. And in that context, one of the things that they really have a very strong desire to show, oddly enough, in the context of what the Conservatives usually stand for, is that Labour is a party of fiscal responsibility. Labour is a party that's not going to create any dramatic populist shifts, as we saw under the Conservative leadership over the last 10 years or so. And in that context, what we really are looking for is a victory by the Labour Party, but a victory that is one which heralds a period of relative stability. It's very hard to see material fiscal policy changes. And again, part of it's because of the reason I just mentioned, because fiscal flexibility is just not there for the UK at this point in time. It would be, I think, an inclination of the new Labour government to get closer to Europe, but I think it's way too premature to think about something more substantial that changes UK relationships with the European Union. I think supply side issues, again, oddly, something you might want to attribute more to the Conservative Party, is going to be a priority of Labour. We're not going to see that until after the election. Right now, I think Labour's basic goal is to try to not be putting out new initiatives, not really playing their hand, having this election be a referendum on the Conservative Party. But I think there'll be supply-side initiatives. Whether they're going to be as impactful of what we've been talking about in the U.S. remains to be seen. But I think continuity is probably the biggest single message coming out of the U.K. election, with obviously a change in government.
Thank you for that answer, Bruce. Very interesting.
Turning to you, Joyce, markets appear to be pricing in relatively little risk premium for the elections in the U.S., given what we've described in terms of the policy implications. Are market participants overly complacent? How are you seeing overall the market implications here?
Well, if you take a look going all the way back to 1945, I mean, we've had positive S&P 500 returns for all but 3 presidential terms. So the markets have usually been pretty complacent around the U.S. elections. And as you said, I think there's a sense that overseas there's a lot more worry because there has been industrial policy and crowding in investment to the U.S. with more concerns about what's going to happen to U.S.-China relations and also what's going to happen with Europe. But I think the markets are not going to really focus on what the election outcome will be until closer to the date because, as you said, the most likely result seems to be a divided Congress, but also just very narrow margins. When we take a look back at 2016, it came down to 4 to 5 swing states. And in 2016, Hillary Clinton was only defeated by 77,000 votes in Pennsylvania, Michigan, and Wisconsin. If you look at the margins in 2020, Biden defeated Trump by only 44,000 votes in Wisconsin, Arizona, and Georgia. So I think the market hasn't focused on wanting to make a call yet, even though there is consensus that it will be a divided Congress. But I think irrespective of the outcome, this rise of industrial policy is here to stay. both candidates continue to be more hawkish on China without a clear path on how this is going to normalize, although you're going to see much greater use of tariffs under Trump from all of his campaigning, but you've seen tariff increases even under Biden continue. I also think you're probably going to see more congressional action next year as well on CHIPS 2.0, because the first CHIPS Act, you only enacted about less than 60 billion of the 250 billion that was approved. So I think there's still more volatility to come closer to the election date.
Okay, so following up on your point that foreign investors are concerned about the U.S. election, perhaps even more so than domestic investors, which countries do you see as being impacted more by the U.S. outcome? What are the implications in particular for Russia's conflict with Ukraine and U.S.-China relations?
I think that Europe and China are most impacted. The focus on Europe will be on NATO, and Trump has said that his support for NATO is contingent on them coming up with their share. If you see fragmentation on the support for Ukraine, that could affect the unity in Europe around this issue, as increasingly there are very few people talking about a Ukraine victory now, just that this is an ongoing conflict. So Trump has said he wants to end the conflict on day one. On U.S.-China, he has made very public statements about tariffs, including a 60% tariff. And we've done some work just looking at this. And as you said, there's the one-off inflationary impact as well. But we've also looked at what this would mean with respect to U.S. jobs, what this would mean if it were really to go into effect. Now, some of this is obviously rhetoric, but we do think it will be a harder line on U.S.-China relations, more focus on looking at rules of origin, countervailing duties, export restrictions, not just tariffs.
So it's a dramatic choice we're facing in November. Markets don't price much risk in. What market implications do you think there are, if any, for the U.S. election, given that so little risk premium has been priced in thus far?
I think that U.S. investors think Trump, is this going to be stronger dollar and still positive for the S&P 500? So when we go overseas, the first question that comes up is the U.S. elections with negative consequences. I mean, just the feeling that these industrial policies are going to be a tax on the rest of the world. That's the real question we're getting from foreign investors right now.
So, Joyce, what other elections are we keeping an eye on around the world?
Well, emerging markets has a lot of elections coming up. So you have Mexico, India, and South Africa. And probably we're getting the most questions about Mexico because of USMCA. There have been some questions about whether Chinese suppliers are relocating to Mexico, and this could come up as an issue with respect to rules of origin. There are also just questions coming up about border issues as well, and whether some of the assistance that has gone to Europe could be redeployed for border issues.
Thank you very much. Very interesting.
Well, thank you, Bruce, so much for your comments, and a lot to think about as we head into this election cycle, because it does look like it's going to be a very narrow result, as we've seen in the past elections. And there are global implications here, perhaps more for the rest of the world than the U.S. when we look at this over the course of 2025 when a new administration does take office. Thank you all for joining us on Research Recap on the Making Sense podcast channel.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. This communication is provided for information purposes only. Please read JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2023, JP Morgan Chase & Co., all rights reserved.